I'm pleased to introduce our first speaker, Susanne Meline. Susanne is the CEO of Ember Peak Capital here in Bozeman. Her bio is in your agenda along with all of our speakers today. She's a founder, an investor, a board member of emerging growth companies operating in highly specialized sectors, addressing unique risks, and an all-around fascinating person. Susanne will be talking to us about the cost of capital, or as she might call it, capital is your co-pilot. Please help me in welcoming Susanne to the stage.
Good morning, everyone. How's my volume there? Okay. Welcome. First of all, thank you so much for your time and attention. It is the most valuable asset that we all have, and I've got you for 50 minutes, which frankly is a long time to hear myself talk. So I may attempt to integrate you into our conversation here because, as was previously mentioned, we have a rich environment here of regulators, entrepreneurs, bankers, capital providers, and it is in that richness that we can find our way for successful entrepreneurs to succeed. So one thing I think my bio doesn't really encapsulate, and I do think it's really important, is just to understand that, like, I'm going to talk to you guys about finance and capital here. I don't have formal training in finance. I don't have an MBA. I got into business school. I had like a 2-year-old daughter. I couldn't figure out how to get her off the wait list for childcare. So everything I've learned that I'm going to talk to you about today is from the School of Real Life, aka the School of Hard Knocks. I have sat at every seat at the table, meaning that I have started out as a lawyer. I was an investment banker, so I help companies raise capital, buy and sell themselves. I co-founded a hedge fund, so I was an investor in public companies. I've also personally invested in private companies. I was an investment committee member for a venture capital fund that specialized in providing capital to early-stage female-founded or led businesses. And I sat on 10 boards of directors, which is kind of scary. 2 nonprofits, 2 like offshore finance-related firms, 2 private companies, and 4 public companies. So it is from sitting at all those seats at the table that I think I do bring a unique perspective, because I know what it feels like to be an entrepreneur. I have Ember Peak Capital. I recently raised a fund. I know what it feels like to go around and just be like, please give me money. I promise I'll do good for you. I also know what it's like to be on the other side, right? As an investment banker or a capital provider, we have the opportunity to see hundreds of businesses over the years, whereas most entrepreneurs have the experience of just seeing their own. So sometimes we can bring information to you that you don't have. So in that perspective, I think one thing I'd like to know is like kind of who I'm talking to today. So can people who work in like banking, accounting, or finance, can you guys raise your hand so I know who you are? Okay. Some of you guys are going to be a little bored by some of the stuff I'm saying, so feel free to, check the stock market and give me like a wink if anything bad's happening. Okay, so how many entrepreneurs do we have that have started their own businesses? Okay, hopefully some of the stuff I'm going to say to you is useful or just illuminating. So out of those of you who are entrepreneurs, can you raise your hand, or again, if this like feels too personal, you can just kind of give me one of those. How many of you are like pre-revenue, kind of just like idea phase? Okay, great, a decent amount. How many of you are cash flow break even? So you generate revenue, you cover your expenses. Okay, great, congratulations. And how many of those are generating, operating profits? All right, okay, last question. How many of them are kind of above 5 million or below? How many above 5 million? Okay, we've got a great mix here, thank you. Okay, and so for those of you that are not accounting, finance, or entrepreneurs, how many are government regulators, sort of? Great, FINRA. I'm a FINRA arbitrator, by the way, but I never get called. They never call me for cases. So FINRA arbitrator is, we seek to self-regulate and kind of resolve our own problems within the industry, right? Okay, and then for others that are not, can you raise your hand of a category I didn't cover? Okay, I'm going to put you guys on the spot. I went to law school, so Socratic method rules the day. What's your business, or what's your?
I'm the chief executive of Ability Montana, which is a nonprofit that we serve people with disabilities across
Awesome.
Montana.
Okay.
And
Okay, you sir over there?
Securities lawyer.
Oh yeah, lawyers. Yeah, we got some lawyers in here. Okay, a couple others. Yes.
Yeah, we're with the MSU Launchpad, so we advise startups.
Awesome. Yeah.
I'm the Regional Program Director for the Small Business Development Center for Gallatin and Park Counties.
Okay, great. Thank you. Okay, so one other thing I want to just mention that's not in my bio is kind of where I started out, because I think it's really important. We just talked about how 99% of businesses, 99% of Montana is like small businesses, et cetera. I came out of law school in the early 90s, and for those of you that are old enough, I don't know if anybody remembers the economic climate at that time, but it was not good. We were kind of like the United States had a big fat hangover from an exciting new development that Wall Street came up with, which is called leverage buyouts. Anybody old enough to remember the days of LBOs? Yep, okay, Michael Milliken. And for those of you that aren't old enough, maybe you've read Liar's Poker by Michael Lewis, Predator's Ball, or Barbarians at the Gate. And so this is just like a macro environment where the idea is you kind of take a bunch of small businesses or medium businesses, borrow a big fat smoking pile of money, roll them all together, and then the synergies, that's such a business school term, the synergies would make it all work. And this is all financed by an instrument called high yield bonds. Really, they became known as junk bonds. And so what happened is a lot of those businesses, some of that kind of philosophy worked, but a lot of them it didn't. And so I'm trying to get a job coming out of law school, and there just aren't any. Law firms aren't doing a lot of business. And so I had the insight one day that like the business that was growing at the time was the business of failure, to be honest. That was the business that was growing. So with that, I went to go work in the US Bankruptcy Court. And the reason I'm mentioning this to you is because it was in this environment that I became extremely interested in business. And one of the things about entrepreneurship is every single one of you, you're out there taking risk, okay? Why do we take risk in the United States? We do this more than any other country. It's one of the most important aspects of the US. It's because we allow people to fail here, okay? Nobody's gonna take a risk if they can't fail. So our US bankruptcy system actually provides the structural support for companies to work out sort of their cap tables when things don't work out. So therefore, we don't put people in jail. Failure is almost considered a badge of honor, I would say. We're kind of like go big, go home, or no pain, no gain. So I think that our structure that we have here enables all of us to take risk. And the reality is entrepreneurship is a risk, right? The majority of new businesses don't work out the way they're intended. And I mention that because right off the bat, when I was working in bankruptcy court, I could see kind of three categories of businesses that would come in. And I'm going to talk to you about the third is really what informs my talk today. The first set of businesses were pretty obvious, right? It was like something that was like a sector. It's gone wrong with the sector. Like we've recently seen this with like airlines, okay? So suddenly gas prices spike. Every single airline struggling, and some of those would come into bankruptcy. The second category was just like obviously bad management, right? You just see people who, were in charge of companies and they just do things that were just like obviously not gonna work. The third category was more intriguing because these are what I'm gonna call idiosyncratic cases. So you'd see one business that's not thriving, but then there'd be four other ones that were really successful, right? And this is where I really wanted to dig in and understand like what it was that I was seeing there. And so kind of the success or failure of that business was like a little bit hidden. And so that's where I wanted to try to understand like what was underneath there. So I think I'm going to talk today a little bit about, I'm going to have a hypothetical entrepreneur, couple entrepreneurs that I'm going to use as an example to sort of show some of my points. Again, banking folks, finance folks, you're going to be like so obvious, but maybe not to everybody else. So let's talk about a couple of hypothetical entrepreneurs. We're going to have Susie and Sally, okay? Susie and Sally are entrepreneurs. Let's say that they're both super awesome. They're really hard workers. They're respected. They know how to have employees work for them. They're kind of equivalent in that way. And they're also working in the same area, in the same business. Let's say they both work in Bozeman. And let's say they both sell salads because that's a good tongue twister. Sally and Susie sell salads. And actually, I'm going to say that too because restaurant is like one of the most commonly formed entrepreneurial ventures in America. Okay, I think it's like number one or number two. Kind of real estate and restaurants are right up there at the top. And so, let's talk about kind of the what comprises their business. So they're going to have their raw ingredients, right? Lettuce, salad, bowls. They're going to have human capital, the people to do the work. They're going to have FF&E. They're going to have their, their stand where they sell stuff. And then, they're also going to have SG&A, sales, general, and administrative expenses, the advertising campaign, et cetera, et cetera. And let's say that, those are pretty much the same. So maybe those costs of putting their salad together, let's say it's like $9, and they sell their salad for $10. So those are kind of the ingredients. And Sally is doing really well, and Susie's doing really well, and Sally's struggling. So Sally's trying to restructure her business, and Susie's talking about expanding. So you just heard me go through the list of ingredients there of their business. Like, what did I miss? What's the thing we didn't talk about in that mixture of what they need to start their salad business? They got management, and they're very good. Okay, bankers, I'm looking at you. Capital. Thank you. They need the $9 in order to, pay for their salad that they're going to sell for $10. So it's that $9 that we're going to talk about, right? Where does that come from? Okay, and so now we can let's go back to my first slide, which is money doesn't grow on trees. Okay, so the $9, that's an ingredient for your business, and you got to pay for that, right? I tell my kids this all the time: money does not grow on trees. Isn't that sad and unfortunate? So, and this is where I think of like money is your co-pilot, right? It's a necessary ingredient for your business, just like the people, just like the FF&E and everything. And the thing about co-pilots is they don't work for free, right? You got to pay a co-pilot. So, and a co-pilot is going to charge for their services based on how scary it is to fly with you, right? So if you have a pilot with 30,000 hours of experience, you're going to feel pretty comfortable being a co-pilot. You're not going to worry that much. If you've got a co-pilot with 1,000 hours, you're going to feel really nervous, and you're going to charge a lot more, okay? And then the second thing is, obviously, the weather that you're going to fly in is going to be indicative. If it's super stormy, it's going to be scarier, and if it's, beautiful sunny weather, you're going to feel more comfortable. So I think that, and so how much the money costs is going to be pretty impactful on your business. Again, I'm sure that's obvious to a lot of people, but maybe not to others. And so I think the next question would be for entrepreneurs is like, well, how much is that money going to cost, right? How many entrepreneurs kind of have gone through this exercise and feel like they understand like what their cost of capital might be? Okay, we got one here. Two. Okay, great. I am talking to you. So this is, I think, something really important to understand, like why you might feel like you're Susie or Sally, right? So Sally's got the wind at her back. She's doing really well. Sally's struggling. She feels like she's walking backwards up an escalator. Has anybody ever felt that way with their business? They're working super hard. They're doing everything right. And somehow it's just not going to the bottom line. Okay, so how do you know what your cost of capital is? I know all you guys out there are great entrepreneurs. You have your fabulous business idea, like, this is like scary money stuff, or maybe not. And by the way, I could throw out formulas at you guys here, okay? Like if we can all get on ChatGPT, and for those of you that want to dig into this in a more formal way, weighted average cost of capital, capital asset pricing model, like take notes and then put it in the internet. Like, I'm not here to be your finance expert, and I'm not telling you to be a finance expert, but I'm telling you that you probably need somebody to help you understand this, okay? And so a finance and accounting people can really help you. Now, accounting, I just want to make a distinction here, because I found some entrepreneurs that are like, I have an accounting person, okay? Accounting people are really important, but accounting tends to look backwards, right? You're making sure that the assets, the liabilities, the transactions are all recorded properly, and that you have systems in place to make sure that those entries have a likelihood of being accurate. And this is a big deal. But that is backwards looking, whereas finance is forward looking. Finance is going to make sure that you have, you're able to execute your business plan with the right kind of capital. So and this is an area where hopefully we'll find some resources here today, where some of the incubators, the launch pad, people can help you understand like how to look at this and how to go about it. And I'm going to give you like a super basic example. Hopefully that will resonate. It's like nice, easy math. So let's go back to Susie and Sally, our entrepreneurs, right? So Susie is going to go to the bank and try and get a loan. She needs the $9 to fund her business. So now I'm going to tell you that Susie is like somebody about my age. Susie has started numerous businesses and been successful. So she goes to the bank, and she's got a track record, she's got some assets of her own, and Stockman Bank's like, okay, Susie looks like a good risk, we're gonna charge her 10%. Okay, so she's gonna go borrow $9 and she's gonna pay 10% interest for that money, so she's gonna have 90 cents of financing costs. So you can see what that does. So I told you she sells her salads for $10, it costs her $9, and she's got 90 cents of financing costs. And by the way, 10% is probably a pretty generous margin for a restaurant business. I think restaurants have margins, 0 to 15%. It's a thin margin business. So now her kind of after financing profit is 10 cents, and that's a 1% profit margin. So she's profitable, but it's a thin margin, okay? Now we're gonna talk about Sally. Sally is a recent graduate of MSU. She is awesome. She's got straight A's, she's got employer references, she's amazing. Hasn't ever started a business before, so she goes to Stockman Bank. You guys are sitting right there, and they're gonna charge her more, right? She's riskier. So they're gonna charge her 15%, okay? So we can all do the math on that. That is a business that honestly is not financially viable right from the get-go, okay? We can talk about what Sally can do to increase her odds of success, but no matter how hard she works, right, she's gonna have a hard time. And she's gonna suffer the opportunity cost of walking up an escalator the wrong way. So I'm just gonna stop for a minute. Does this resonate? Okay. So we're gonna move on here. And now I want to talk about hidden capital costs, because this one is where I've learned from the School of Hard Knocks, okay? Okay, so three things that can be hidden here for entrepreneurs. The first one is complex instruments, okay? There are, Wall Street and financiers are endlessly innovative. It's a good thing, and sometimes it's not a good thing, as our FINRA people can attest, right? So some of these instruments are really complicated, and if everything goes right, it'll turn out okay, and if everything doesn't go right, you've got a real problem. I'm gonna give you a real-life example here. This is something that a CFO of a publicly traded company, honestly didn't clue into. Okay, so now we're gonna say Sally goes into a bank. They're no longer going to Stockman Bank. She's gonna go to an alternative capital provider, right? And in that alternative capital provider, they're gonna say, we're gonna loan you the $9, okay? And we're gonna charge you 10% interest, just like Susie. And that sounds great, right? But then once you get through page 20 of the loan document, there's a covenant towards the bottom. And the covenant says, you agree at all times to keep $4.50 in a bank account linked to us, okay? So Sally is paying for $9. She's paying 10% for $9, but she really only gets to use $4.50. So what's her real cost of capital there? Okay, it's double, it's 20%, right? So now her business is totally underwater, but she feels really great. She's like, or really what they'll do this. They'll say, Sally, we think you're so awesome. Not only are we gonna give you $9, we're gonna give you $18 because you're amazing. And Sally's like, oh my God, I asked for $9 and I got $18. But she has to keep $9 of it locked up. So she's really paying, 10%, she's paying 20% to use half the amount of money. So I've seen this more than one time. So that's where your lack of, if you don't have experience and you haven't seen it, you're not really realizing what's happening there, okay? Has anybody ever seen this kind of financial instrument before? You have, okay, so yes, yeah. And you just see that number on the term sheet. You just are like, oh my God, I asked for $10 and they gave me $20. And that's part of the kind of pitch. It's like, somebody's throwing money at me, I must be amazing. Okay, so number one is not understanding the finance instrument. The other kind, honestly, if somebody is talking to you about doing any kind of convertible security and it's a floating convert, I'm not even gonna get into this, just stop, do not pass go, and do not do anything until you really understand. To me, if somebody's offering you a floating conversion security, I know FINRA people know what I'm talking about, that means that somebody honestly thinks you're gonna fail, right? And there's probably a ton of fees in there, and if that's the only financing you can get is a floorless convert, that means the world's telling you that they don't think your business is gonna work. So, okay, the second kind of hidden cost of capital is people who bootstrap and use their own money. So we know that when you have money, even though you've earned and saved the money, Like your money can't just sit there and do nothing, right? It'll just get eroded and get skinny over time if it's under your mattress, and pretty soon it'll be gone because of inflation. So money has to go out and do a job, including your own money, okay? So if your money is financing your own business, you have to be careful that your co-pilot doesn't become a hostage, okay? No, I'm serious. So when you have your own money and you're self-financing, I want you to be very aware of what the value of your own capital is and almost setting a standard for yourself and your own money, okay? And I'm just gonna give you an example. So we just talked about Susie and Sally in the salad business. Okay, so if they're gonna self-finance, their competition is they could take their own money and go buy shares of Sweetgreen, publicly traded company, stock price is up 14% year to date. They don't have to do anything. They're just gonna go get 14%. Of course, it could go the other way as well. But somebody else is gonna run the salad business on a large scale, and they don't do any work. They just, they benefit from giving their capital to somebody else. So I'd almost think that if it's me, I wanna set kind of a standard for how much of a return I'm gonna want for my money. The second thing is the value of human capital. For those of us that are entrepreneurs, how many people have worked for free, basically, right? All of us, right? Or many of us. Like when I started a hedge fund, I didn't pay myself at all. The only thing I was gonna do is get a percentage of profits if we were fortunate enough to make any. So a lot of us do that. So you've got your opportunity cost of the job that you're not taking somewhere else, and then you also have the return that you could get on your own money if you weren't self-financing. So I think these are important kind of hurdles for you to put in. And even if you don't want to take the risk on Sweetgreen, we can all do what I call the T-bill and chill strategy, right? The T-bill and chill strategy is you just go get some T-bills and go to the beach, right? You don't have to do any work, no salads, no any of that stuff. So I want people to be aware of that because that is something that I see quite often. Okay, and then the last thing is failing to properly consider the cost of friends and family money. How many people here have taken friends and family money? Okay. Here's a true story. During the pandemic, my husband, my brother-in-law, his wife, my brother, and my sister-in-law thought it would be a good idea to buy a small hotel in a little mountain community. Okay. My daughter was sensible enough to be like, wow, Mom, that doesn't seem like a great idea. Yeah, okay, guess what? Things didn't work out the way we thought. We're 6 years into it. People have different agendas about what could happen. And so Thanksgiving dinner has a different feeling to it, okay? And that is hard to quantify. And the reality is, even if people are like, oh yeah, they'll be cool about it, every dollar that is out there has a story behind it. And unless somebody really gives you the money, when you lose other people's money or put it at risk, they have feelings about it, okay? And sometimes people don't even know what feelings they might have until something comes up. So I just want you to all be very aware of the cost of that human capital from your family that you may not be taking into consideration. Okay, so let's go on to the next slide. So we talked about Susie and Sally have really different costs of capital due to just one factor. One factor that none of them really has control over. So I want to talk about things that I do think can influence your cost of capital, and I may go around and survey the finance and accounting people to throw in things here that I'm missing. So in my experience, the things that you can control are managing your personal finances to the best of your ability, okay? And I say the best of your ability because there's some things you can't control. If you come out of school and you have $50,000 or $100,000 of student debt loans, you can't change that. I'm not telling you to be somebody you're not, but I am telling you to manage your personal finances to the best of your ability, okay? You want to show people that you are reliable, okay? Reliable is building trust so people know that they can rely on you to do what you say what you do, and that is profoundly impactful on how people will interact with you. I think in terms of entrepreneurs, you want to keep your accounting, your books and records very solid and explain to people that you understand about internal controls, that you're not mixing your personal and your business stuff together. Those are things you have control over. I think a budget that shows respect for capital. So one thing I have seen in all my different seats at the table is there can be this big disconnect between entrepreneurs and the money. People on the capital side can be, I'm not going to call it disrespectful, but they can be not as walking in the shoes of an entrepreneur to know how hard it is. And I feel like some entrepreneurs, they just want to get somebody else's money. I call it OPM syndrome, which is like other people's money. It's like, oh, I'm just going to go get some money from some venture capitalist or some hedge funds or some bank, right? And I'm going to go back to this again. Behind every dollar that's at Stockman Bank, behind every dollar that's in every hedge fund, every dollar in a private equity fund is a human being who worked, who saved their money, who paid taxes, and who, forewent buying something that they really wanted to buy, and they saved that money, okay? So when we talk about like how bad hedge funds and private equity funds are, I mean, they're your pension money. I mean, Montana PERS has got 17% of its assets in private equity firms. So it's our retirement money. So I think there needs to be kind of a mutual respect on both sides. And so one area that you can really show this is like in your budget. So when you're talking to capital providers about your budget, like give them the feeling like I do, which is I'm going to treat every dollar of yours with that respect that it deserves and like it's my own money and like it's my last money. That goes a long way. And you see a lot of businesses that are just like, oh yeah, I just got this money. So a budget's the way to show that. Okay, other two things here are really important. Entrepreneurs are amazingly creative people, all of you guys out there. I bet the idea that you're pursuing is not your only idea. I bet you have a whole bunch of them. And so what I'm going to ask you to do is when you're thinking about which one of these am I going to chase, I want you to think about the business model and like what kind of capital that's going to require. Okay? And I'm just going to give you kind of an example of what Susie's secret sauce is, okay? Here's Susie's secret sauce. She's got the salad, so does Sally. Why is she crushing it? Susie knew about Dell Computer. Who knows about like Dell Computer and why they're different from other companies? Okay, Dell Computer, has anybody ever ordered a Dell Computer? Okay, how do you do it? How did you order your Dell Computer? Online. You online? So what'd you do? Customized it, and then what'd you do? You paid for it, and then when did you get it?
Showed up in a couple days.
Couple days, okay. Why is that important? Okay, so let's just say that's the salad, okay? Dell Computer didn't have to come up with the $9 to fund the salad. They didn't have to come up with the money because he paid in advance for his computer, okay? That is genius, absolute genius. So here's what Susie's done. Susie doesn't sell salads. Susie has salad drops, okay? Does anybody have like college-age students who know what drops are? Okay, drop is when like there's a custom thing and then you gotta like get in line and then you order it and then you get it on a particular day. So Susie does salad drops. So that means in advance, you're gonna tell Susie that you want her special salad on Saturday. It's seasonal, it's got huckleberries, and you pay for it in advance and then you pick it up on Saturday, okay? Sally doesn't do that. Sally doesn't really know. So Sally has to go out and buy the ingredients. She has to sit there, she's gotta finance it, and then people show up or they don't, and then the salads go to waste. Okay, so Susie's business model is the key to her success, honestly, because her entire business is funded by her customers. So the more Susie grows, the more of your money she gets. So she actually owes you money. So when I pay for my $10 salad, she owes me that $10 back until I pick up my salad, okay? So does everybody understand that? Okay, so like when you're going through your different business ideas, if you can come up with anything where it's like customer funded, like just alarm bells should go off and be, winner, winner, chicken dinner, and that's the kind of thing I want you to focus on. So you do have flexibility to figure out maybe on how you can go to market with your business idea. And then the last thing would be like flexibility in terms of timing and growth of capital, and this is why this is important. We're going to talk in a minute about things you can't control. You can't control the market environment. I told you when I came out of law school, I mean, it was just a hot mess out there because of, tons of bankruptcies and people lost a ton of money on junk bonds. I can't control that. But if you can control when you need capital, that's really valuable. And how do you do that? If I have a business idea that's got a pretty good moat around it, okay? That means I have a sustainable business advantage. That means that I don't have to like rush to market right now. If the environment's horrible, I maybe can wait to expand my business until maybe the world's like a little better. Okay, if you don't have a sustainable business advantage, you got to get out there and break things like a lot of the tech companies do. They got to get to market real fast because whatever advantage they have is going to go away really quickly. So if you can figure out where you have a sustainable business advantage, that's going to give you that flexibility to time when you go out and get your money. And same with growth. Okay, so now that I talked about like things that you can control, can any of my finance people, bankers out there, is there anything you guys can add to it that I've missed that you feel like would really impact me when I come in and ask for a loan? Oh my God, did I get everything? Yeah? Which one? Oh, did I get an A+? Yeah. Yeah, okay, good. I'm so big on external validation. I know I'm supposed to be bigger than that at my age, but I'll take it. Okay, so now let's talk about what you can't control. Okay, this is like the weather we talked about. Co-pilots are going to charge you more if the weather's bad. So, overall health of the financial markets. We can't control that. Your personal attributes. This is something that can be really frustrating because you can't do anything about it. So we just talked about how, Susie's older and more experienced and Sally's not. I mean, for Sally, it's just a bummer, right? It's too bad. We're saying she's just super experienced, just like Susie, but because of her youth and because she hasn't started a business before, people are going to view her as a higher risk. Like, that's not fair, but it's the reality, right? People will have, people engage in like pattern recognition. So if you see a guy who's a 22-year-old lacrosse player who's going to launch like a direct-to-consumer cosmetic company, people are just going to be like, wow, I've never seen anybody succeed in that field, kind of with this demographic, because people like kind of believe in entrepreneurs. If you're a really, like an older person trying to start an AI company, people are gonna like not see that pattern recognition. I can tell you the number of women who run, hedge funds, private equity funds is like very few. So that's just gonna kind of be something that swirls around you. I think it's important to be aware of it. I don't spend too much time shaking my fist at the universe because that's all energy. I could be focusing on things that I can control, but I think it's important to be aware of it. And I think the other thing that we need to think about is every business is an experiment, right? Again, everyone's got different ideas. Every business is an experiment. Like, I try and think of it as like there's not good or bad. There just is like what's happening around you. And being able to kind of disassociate yourself as a human from your idea and just know that you're kind of putting stuff out there and getting feedback, and your job is to take in the feedback, to live in reality, and to go forth accordingly. Okay, so now we're going to talk about, we can move to the next slide. Okay, so we just talked about how there's like different attributes that are going to, affect your cost of capital, and some of them are outside of your control. So like, how do you deal with that as a business owner? And there's kind of two things that I've seen people do. One is when you kind of look at your business to begin with, you make sure and understand, like you kind of really build in a margin of safety or a sensitivity analysis and like projecting like how you're going to do. So I gave you like Susie and Sally. I mean, both of those businesses have really thin margins, okay? Really thin margins. So if something macro happens around them that they don't have control over, that could actually send their business from being profitable to unprofitable pretty quickly. So that's something I really want everybody to be aware of. And if you have a business that's got such thin margins and your sensitivity analysis shows that something outside of your control is going to like send you cash flow negative, I think that's really important to be aware of that right up front. Or you're going to have a dynamic cost of capital and you're going to be updating it all the time. Because you can be successful one day and then 6 months later, some external thing can happen and you're in trouble. Rising gas prices, human capital cost, your interest rate went from 10% to 12%. So at that point, you want to always like be making a dollar grow bigger, not smaller. And sometimes, I mean, this is really hard. And out of all the things I've seen that separates good entrepreneurs that succeed from ones that don't, it is how people deal with these unexpected things is just really a key element. I put the word in here, puppy drowning. Wall Street is so full of like just generally offensive things. And so puppy drowning is like what finance people will see in entrepreneurs where they're really identified with their business as like their child. And so like saying that the business idea isn't going to work, it feels as horrible and awful and cruel as drowning a puppy, okay? And this is where humans have features and bugs. A feature of humans and entrepreneurs, all of us, I mean, we're all super hard driving. I mean, I don't take no for an answer. Like, I'm gonna keep going out there and doing it no matter what. That is such a gift to me in some ways, but it's also a curse in other ways. So I have to be aware of when it's serving me and when it's not serving me. And so when you kind of, the macro climate's against you, I think it's really important to like have the conversation about like Do we keep beating our head against a wall here? And if you're not careful, you can be like a company I was on the board of. I was on the board of a company, you know what they were really good at? They were really good at taking $1 of investor money and turning it into like 15 cents in like 6 months. It was horrifying. I mean, the stock chart looks like this. I mean, they would just raise more money on extractive terms, and there was no way they could overcome their cost of capital. There was no way they could create enough value to overcome like how risky they were. And like, I don't want to be on the board of like, why do we want to be in businesses that are destroying our own capital or other people's capital? And the second thing is, if you're spending your time pursuing something like that, what about your opportunity cost? Every one of us has different ideas. So by continuing to pursue something where you're destroying value, the most important oversight is that you're not pursuing something else. It's that opportunity cost. So I think that is something I want everybody here to really think about. And other things that we can't control are regulatory changes, right? So suppose Bozeman decides that they're not going to allow people to sell salads on the sidewalk anymore. Nothing you can do about that. It's going to affect your business. Societal. People say they hate salads. They're now only going to eat steaks. And then I think the last thing we'll talk about a little bit later is what we call black swans, the unknown unknown. So, we have a couple minutes here. I'm going to ask you guys to do something because, again, I've sat on a lot of boards. I think it's really important for entrepreneurs to give equal weight to everything that's going to go right and everything that's going to go wrong. And this is all of us. So, I trained as a lawyer. Guess what lawyers are really good at? They're super good at identifying all the things that are going to go wrong, okay? And that's what they're paid for, so it makes sense. But they also never think about or give equal airtime to all the things that are going to go right. Entrepreneurs, I find, tend to do the opposite. They give overweight everything that's going to go right, and they don't talk at all about the things that are going to go wrong. You need to give equal weight to that. And the benefit of that is it's almost like, I don't know, I'm going to call it exposure therapy. Does anybody know, if you're scared of spiders, what's the treatment for that? Yeah. Okay, if you have a spider phobia, you're going to pay somebody and they're going to put a spider on your arm. And what are you going to learn from that? That it's not going to kill you. And your brain's going to learn that it won't. I suggest that the same thing can be true for entrepreneurs. It is very threatening and very hard to think about how things might go wrong. And I think, people are into manifestation and stuff like that. So I'm like, dude, just because you think about what might go wrong, that doesn't mean you're manifesting failure. I think it's really important to give equal airplay. So I'm going to ask you, and every time you do that, by the way, you're like, oh my gosh, well, what if, I don't know, a virus happened and everything got shut down. And just by thinking in advance about what you might do under some of these circumstances, it doesn't mean that that's the answer. It just means that you've given some practice to thinking about it, so when the thing happens, it's going to be easier for you to kind of get out of the fear part of your brain and reactive part and be like, I could do this, I could do this, I can think of alternatives here. So I'm going to ask you guys, I've been talking for a long time, so let's just take a break here. I'm going to ask all of you guys to just talk to each other for 3 minutes and say everything, whatever means something to you. Your kid's soccer game, your business, some meeting you're going to at work. What's the 3 things that can go right and the 3 things that can go wrong? Okay? Can you guys do that? Okay. The worst thing that could happen. Okay. I'm going to give you literally 2 minutes. Okay? Okay. I'm going to bring everybody back now. Okay. Everybody back. I'm going to ask somebody to who's willing to volunteer the thing that they're worried about that could go wrong and what they might do about it. Do I have a volunteer? Yes. Oh no, I'm going to ask people. I just ask people to kind of expose themselves to the idea that something might go wrong. What could go wrong, and what would they do about it? Just kind of as an exercise of thinking about the worst case scenario and hopefully the best case scenario too. Anybody willing to volunteer anything? Oh, you're so shy. Okay. And this is one thing when you guys do go talk to Capital, they may ask you questions like this. So this is what I call a pre-mortem. Pre-mortems are really valuable. Pre-mortems are basically where you think about the things that can go right and the things that can go wrong. And again, it's not about saying I don't believe in you. I don't think you're a great entrepreneur. I want to see what your thought process is. If life comes and slaps you upside the head, what are you going to do with it? Are you just going to sit there and be like, oh, well, you don't believe in me, or some kind of trope like that? Or are you going to say, well, honestly, the three things that I sort of think could go wrong might be this, and I would do X, Y, and Z about it, okay? I'm looking to see people's thought process. And the reality is, again, is the things that are going to get us are, let's move to my next slide, the black swans, the unknown unknowns, right? That's the reality. Those are the tail risk that none of us can even contemplate. And so what I want to know and what I think about for myself is like, well, when that thing comes and slaps me in the head, like, what am I going to do about it? And having given weight and time to think about like how we might react when things go wrong, I think is really valuable. People aren't able to do that, I'm telling you. I've seen it a lot. They're incapable of it because it feels like a personal attack on them, and it's really not. And you have to remember that finance people have seen hundreds of businesses, so they might know something that you don't know. And it's really valuable to be like, well, what are you worried about, or what do you see here that I don't? So it's a great resource. So now we're going to talk about the last slide, which is liquidity. So you've all heard the expression, cash is king, okay? Liquidity is lord. That is really important, okay? And liquidity, like to some people, means cash, but liquidity is really more than cash. And so I want entrepreneurs to really understand what your liquidity profile is. And why is this really important? Because understanding your liquidity is going to help you deal with those the stormy weather that you can't anticipate, right? Again, we talked about how you can have impact on your cost of capital and where you can't. Liquidity allows you to stay in business, to kind of formulate a plan to deal with that. And so the reason I mentioned liquidity is a couple things. I've got a formula here because, you know, got to throw in one formula. But really, do you have access to funds to continue your business? And so usually entrepreneurs, like my experience is, they'll kind of look at things one way, which is, A, I'll go out and raise more capital, or I'll cut expenses, okay? If you have a liquidity problem, you're going to have to go out and raise capital when you kind of have your back against a wall, and that's going to like eliminate your flexibility that I spoke about, which is a key element of business success. And a lot of entrepreneurs will say, I'm just going to cut expenses, okay? And that sounds good, but the reality is that most businesses, you're not able to cut expenses as fast as you think you're able to. So I really think about like what it is you're talking about and how you do that, okay? And I'll just give a couple of examples. You have a lease, right? You can't just like stop paying your lease. You're going to have terms in there that require you to pay or have a termination fee. And like human capital is really important too. Like we have laws in this country that protect employees. And if you're going to downsize your business, depending on how good or small you are, you can't just be like, so sorry, I'm not paying you anymore. You know, so you have to really understand like how long would it really take you to shrink your cash flow. In my experience has been that that's a lever that can't get moved in any close to as fast as people think it can. So you think about that in advance, because again, people are going to ask you about this. And the other thing I'm going to ask you to think about is like, you may have your own values that you're going to bring to the equation, okay? So just because like federal law requires you to pay people for 4 or 6 weeks, you may have a personal belief or personal philosophy about how you want to run your business, and you're going to want to take this into consideration about how you manage your liquidity. And again, we have to understand that a lot of businesses, people aren't successful the first time, and we want you to be able to get back on the horse, go back to the rodeo and try another time, and kind of how you address like liquidity and things like this is going to be part of how people are going to find you reliable and respectful going forward. So I think the last thing I'd want to do is think about establishing like an organizational turnaround time. Like how many people are like hikers or like outdoor people? Backcountry skiers. Okay. So when you go out, like you probably in advance think about, well, I'm going to hike for 4 hours, and then when the sun gets to this level, I'm going to establish a turnaround time, even though I could probably keep going. I want you guys to all think about like what's a turnaround time for your business, right? What's the turnaround time? So you can manage your capital and manage your business in a way that's going to lead you to future success. And with that, I think I would like to see if anybody has any questions. Is there anything that I can offer to you guys that would be helpful? I think actually I want to make one other small point. We talked a lot about kind of protecting the downside, again, because that's what capital is going to be concerned with. I also want to talk about other black swan events. Last point is things can go like incredibly right, and you have the black swan can be like the upside. And I'm just going to give you an example of a publicly traded company that was in the business of ethanol. The stock was 50 cents a share. Like ethanol is a pretty tough business, 56 cents a share. Okay, well, after the pandemic, the black swan for them was all of a sudden nobody cared about ethanol, but they cared that they could make hand sanitizer. So their stock went from 56 cents a share to $11 a share in like 60 to 90 days, okay? That's a black swan in the other direction. So all of a sudden for them, their cost of capital plummeted. Okay? Now, if they hadn't had advanced plans on like things that they would do if their cost of capital came down, they would have missed the window completely. But because they were ready for it and they had thought about like what if something crazy amazing happens, they had some ideas about how they deploy the capital, which was to build another factory. Okay? So black swans can go both ways. So with that, I would like to thank you for your time and open it up for questions. I know people, like there's an app, but people can, it's small. You could just throw out your question.
We have some folks walking around with microphones. We are working on our little glitch in the app, but in the meantime, we're here. We can take questions live, so, yeah, okay. Go ahead, stand up and shout. No one can hear you. I might get there by then.
Where does, we do small business lending, and where does collateral fit into how much you make? We deal with small businesses that ends up coming up as collateral for.
Yeah. Think of all the businesses. So that's great if you have a business that has assets, but for a lot of businesses like don't have assets, right? Sally and Susie, man, they don't have anything. They got a lease. So plenty of businesses, I think especially in 2026, people tend to gravitate more towards, I'm going to call asset-light businesses because there's less of a capital raise. So I think that can be really challenging. So then you're talking about securing a loan like on your personal residence or something like that, or I know we have somebody talking about intellectual property today, like how appealing of sort of an asset class is that to lenders, right? So how do you address businesses that don't have physical assets? It's extremely difficult, right? So that's why when you think about your business model, you have to understand what's going to be available to you and what's not going to be available to you, right? Okay. What else? Come on, guys.
Follow that up?
Yeah.
Suzanne, right in the beginning, I'm a chef, so it's interesting. You said something about real estate. You said something about real estate and restaurants.
Yep.
But I failed to get the first part or the finish up to that. What was that point?
Those are just the most common businesses in America. Like if you look at like what are the greatest percentage of new businesses started, it's restaurants and people making investments in real estate. And you're a restaurant operator, so I'm super excited to hear what you have to say. You're living on the ground. Okay. Oh my gosh, is it crickets? Yeah. Okay, yeah.
Is there a difference for capital raises? For capital raising, particularly as a solo entrepreneur starting out, are there any alternatives to either a debt instrument raise or a equity offset? Like, are there anything other than an asset, which is obviously very difficult?
Yeah, I mean,
Is there anything to come to the table as a new person to business?
I would say I see some innovative financing structures around like licensing. If you have something that can be licensed like IP, so like a royalty financing instrument. I mean, these are more legally intensive. So I know we have a medical entrepreneur in the room here, but maybe I might be able to provide you financing where you go out and sell a product, or you have licensing revenue, and I'll say I'll lend you money, and basically how I'm going to get paid is I'm going to get a percentage of your licensing revenue, and then you have hybrid instruments. Hybrid instruments can get complicated and sophisticated. I mean, I'm just going to be honest with you guys. The best businesses are one where you can come up with a business model where you can you're going to be able to self-finance, like the salad drop that I talked about. So any way you can innovate around businesses that are like capital light or somehow kind of customer financing, you kind of sidestep that. I mean, that is the Valhalla. So that's something that I think about a lot. Okay.
Thank you.
Thanks so much, Suzanne. That was a great presentation. There's a reason we had her lead off because I hope she's already sparked some interesting questions for some of you. I was able to hear a little bit of your conversations at the table. Keep having those.